All right. So today, Dr. Eugene Cantor will be giving his second lecture on his three-part series on accounting for Maryland Rebooted. Eugene has taught accounting courses at University of Maryland for many, many years. So today we're very excited to have him as a speaker for the second time. So I'm sure everybody already attended his first webinar 2 weeks ago. That was very engaging and really gave some insights into the basic accounting system. And today he'll give us some insights on the topic of income and cash flow, as well as financial statement analysis. My name is Nicole Kim. I'm a coordinator for the program, and I'll help moderate any questions that you may have for Eugene today. So we ask you to stay muted throughout the lecture, just for the sake of flow, but welcome any questions that you might have throughout the lecture. So please use the Q&A section. If you have any questions at all, I'll deliver them to Eugene. All right, so now without further ado, I'll hand over the floor to Eugene.
Well, thanks a lot, Nicole. I appreciate it. And thank you all for coming today. In our second module, we'll be talking about income cash flow reconciliations. It's really a little bit more on trying to teach the accrual accounting system. And what we'll do is reconcile what is accrual accounting with cash accounting, or the cash flow, the cash income statement, or income versus the accrual income. And as I say, it's just another way to test an understanding of exactly what the differences are between cash computations of income and accrual computations. And then we'll move into financial statement analysis, which is a way to present techniques that are used oftentimes by banks and investors, as well as managers of companies, owners of companies, to try to test how their company is doing based on various criteria, typically in the form of ratios. I just want to mention that we did get one question last week or 2 weeks ago about whether nonprofits use the accrual accounting method, and I did some checking on that. And it is true that they can use either cash or accrual. And I found an article that Nicole's going to put, I think, that's put into the chat box that is a really excellent article describing the two methods for nonprofits and specifically recommending that they use the accrual method accounting and indicating why they should. So I thought I would throw that out there. And I think there was one other question on goodwill that I think I addressed, but I just wanted to reiterate it. And we might recall we talked about goodwill arising on the financial statements only if it's purchased, only if you purchase a company. It can be self-generated, but you won't see it on the financial statements. And goodwill comes about as a result of a company demonstrating that it can get a higher rate of return than companies similarly, and you can't really account for a specific asset as to why that's happening. So the way it's computed is that the accountant will determine all the identifiable assets of a company, both the intangible and tangible assets of the company, add them all up, value the company, and any additional value of the company is deemed to come from goodwill. Again, it won't evidence on the balance sheet, won't be recorded by the accountant unless a company actually pays for it, actually buys up a company and then pays more than the amount than the identifiable assets add up to. So the question specifically was, well, how, we talked about goodwill impairment, and I said that you do measure occasionally whether there's been an impairment in goodwill, and that would be demonstrated by the fact that the accountable assets, when subtracted from what was paid by the company for the goodwill, no longer are justified. You don't have enough value there anymore. So maybe you had book goodwill of $100,000 originally, and when you account for all of the identifiable assets, you only have an extra amount now of $80,000. So you've got a $20,000 impairment. And so you have to write that down on your financial statements. Now, how would an impairment happen specifically? I think the question related to a company that was engaged in, maybe a high-tech company, and maybe the value is coming from the individuals that work for the company. And again, it could be any type, the impairment would be manifested again just by that computation. What could cause it could be a loss of employees or any other type of loss in the company's goodwill due to any other means, whatever else might be going on with the company. It might be a loss, for example, it may have certain secrets and now there be no longer, becoming obsolete, may no longer benefit the company as much as they used to. So it could be a number of different issues. Okay, so let's go ahead now. I just wanted to very briefly review where we are. So in terms of the first module, again, we went over the accounting conceptual framework, and we described the fact that the accounting profession had to develop a way to communicate information that was useful to primary users of their financial statements, and those are creditors and investors. And so we determined that there were 4 primary financial statements that would provide that information: the income statement, statement of retained earnings, the balance sheet, and the cash flow statement. We went through the accounting equation, which is assets are equal to liabilities plus stockholders' equity, and determined that the stockholders' equity consists of 2 parts: the common stock, or if there's other stock issues like preferred stock, plus retained earnings. The assets are items that are owned by the company, and that could include a lease that the company owns. And those assets had to come from one of the 3 sources we discussed: liabilities, meaning there was a borrowing, issuance of common stock, or earnings, which are manifested by retained earnings. And then we worked through some transactions and produced 4 financial statements, again, the 4 that are here. And we discussed the concept of accrual accounting, which, unlike cash, which accounts for revenue when money is received and expenses when money is spent, the accrual method will recognize revenue when it is earned, which means that the products or services haven't been actually delivered, despite the fact that payment has not been received yet. And expenses are recognized not when paid for, but when expenses are incurred, meaning that you've either purchased an asset that is now expired. You may have bought 2 years worth of insurance and a year has gone by. So you have to write off that year's worth of insurance that you had on your books as an asset, and it moves to expense. Okay, so that brings us up for our topics today, which will be, again, cash flow, essentially reconciling cash and accrual accounting, and financial statement analysis. And we'll look at a number of ratios. I'll just mention again that the 3rd module will be talking about managerial accounting concepts. That's accounting for managing a company. We'll look primarily at budgeting, but some other concepts as well. And then we'll discuss some PPP tax issues. I'll go through some tax planning in a time of COVID, and also some payroll tax issues as a result, and loan forgiveness issues as a result of the COVID legislation. Okay, so we're going to have 2 handouts for today. This one, I'm being a professor, I'm not going to give you the answers right until after the program. So here's our materials for today that we'll go through, and then you'll get at the end of class the answers to our reconciliation and to our ratio analysis. Okay, so that's what we'll be working with today. So we'll start out with the discussion again of reconciling accrual, net income, and cash flows. And this is just really a way of trying to make sure that we understand the accrual accounting system. Again, I should mention that for smaller businesses, there may not be huge differences between cash and accrual. Accrual still generally is a better means of looking at income, determining income, in addition to the fact that banks typically will want to look at accrual. So they might do a reconciliation on their own of a company. Okay, so we mentioned that there are 3 types of activities for cash flows: operating, investing, and financing activities. And we'll talk more about how they should look on the cash flow statement. The operating deals specifically with earning revenue and incurring expenses. Investing deals with purchasing longer-term assets such as machinery and equipment and buildings. And financing would be issuing common stock or borrowing to get your financing. Now, the accrual, we did a special worksheet on accruals and deferrals. And you might recall we said that an accrual would be a situation where you're going to recognize either a revenue expense on the income statement, but you're not going to receive the money or pay the expense yet. So in other words, with an accrual, income statement effect first, cash flow statement second. With a deferral, you might purchase an asset and you would defer recognizing that asset as an expense until the asset actually expired. Or you might say receive revenue in advance, you have not earned it yet, so you have to defer recognition of it on the income statement as revenue and treat it as a liability. So the deferrals, you have the opposite situation. You have a cash flow in or outflow first, and then you have an income statement effect second. All right, so here's an example. Assume a company makes a sale on account for $500. Remember, we said that on account means that they haven't been paid yet, so they record an account receivable. The sale will generate revenues that will increase net income. However, cash will be unaffected by the sale because it was on account. We recognize the revenue even though we haven't received the money yet. Cash method, you'd recognize the revenue when you receive the money. So the sale generates the account receivable. The opposite would happen when the receivable is fully paid. Later, cash is increased, but the net income is, of course, unaffected because we recognize the income at the time we made the sale. Now, as I mentioned earlier, we're talking strictly about timing differences here between cash and accrual. So for example, assume a company receives a bill for a utility expense for $500. At the time the bill is received, the company records an expense of $500 that reduces net income and records an account payable that shows the utility payment is owed. So they haven't paid it, but they have to recognize it under the accrual method because they've incurred that expense. Then no cash was dispersed, no payment was made. And then when the payment is made, cash is going to be dispersed and the liability is going to go away. They're going to have paid off that liability. So the keys to revenue and expense recognition under the accrual method, we have revenues recognized when earned, products are delivered or services are rendered, expense recognized when incurred, accruals occur when revenues or expenses are recognized before cash is received or paid, deferrals occur when revenues or expenses are recognized after cash is received or paid. Okay, so that's a little review of what we covered. And so this is just a way for us to put it together to see, can we determine based upon, say, a net income figure, if we knew what the adjustments might be, how to compute what the cash flow was, or what the cash is for the company based on the adjustments that we've been talking about. So here's some examples of what we're going to do. Let's say that a company is showing under the accrual method net income for 2019 of $10,500. And during the year, I want to know what the cash flow was for 2019. And you'll note here that we're going to make an assumption that each transaction or event occurred in a different year and that it was the only transaction in the year that makes a difference between net income and cash. So the first example, we made a sale of $500 on account. So if I am given a net income figure of $10,500, what was my cash flow if that's the only difference between the accrual income and cash flow? Well, I know that the $500 was included in income for the period. So I know that the impact that that transaction had on income was to increase it. Did I receive any cash? No, it was simply recorded as an account receivable. So the cash account was unaffected. So if I start with a net income number of $10,500, and I know the only difference between the net income and the cash flow is booking this transaction, making a sale on account, to get to my cash flow number, I have to subtract $500. Why? Because for net income purposes, I recognize $500 of additional income on my books, but for cash flow purposes, I wasn't paid. So my cash dollar amount is $500 less than my net income if that transaction represents the only difference. Let me stop there for just a minute and see if anyone has any questions on that. Okay, so that's a key kind of analysis we're going to do with a couple of problems we'll look at. Let's take a look at in 2020 now, we're going to go ahead and we're going to collect the $500 account receivable from the previous sale. Now, we've already recorded that as income. So if our net income was $13,500, the net income is unaffected by that collection. Why? Because we recorded it back in 2019 when we earned the revenue. So what happened to that transaction to collecting the 500 in my cash account? It went up. So to figure out what my cash flow was versus my net income, my cash flow had to be $500 more, because the net income includes, or I should say the cash flow includes $500 of cash collection that did not increase our net income because the net income was previously recorded in 2019. Okay, let's take a look at another example. Net income for 2019 is reported at $22,500. We received a bill for utility expense of $500. What was the effect on net income? Went down. What was the effect on cash? We didn't pay it yet. We recorded a liability, right? We owe it, haven't paid it. So I'm going to add $500 to the 22.5 because net income number of 22.5 was decreased by the expense, but the cash flow was not. So to get to the cash flow number, there's a $500 difference. Cash flow is higher than the net income reported by that amount. Now, what happens when I go ahead and make the payment in 2020? Does that make a difference between the net income number that's reported and the cash flow? And indeed it does, because the net income is not reduced by the payment of the utility bill, because it was reduced previously in 2019 because of the fact that it was expensed at that time but not paid. But the cash flow was reduced by the payment, so I can figure out my cash flow from my net income number by subtracting 500 from the 18.5. Just make a note here that if the accruals and deferrals reconcile within the same year, that is to say that the revenue is received, even though initially it was sale on account, it's received later in the year, there's no adjustment that you need to make for the year-end numbers. But we treated these as happening in different years to show the difference. Okay, so let's test our understanding of differences between cash and accrual accounting. And we'll say that we have a net income number of $44,500 during the year. And these transactions occurred that might result in a difference between the net income number and the cash flow for the year. Can we compute the cash flow, which I've given you here? Are we able to compute that by understanding what adjustments need to be made to the net income number to compute our cash flow? Let's work the first one together. How about that? So we received $40,000 from the sale of issuance of common stock, right? So you might recall from the examples that we worked last class, the income statement reflects revenues and expenses. Dividends do not appear on the income statement. They're just a distribution of earnings. So a receipt of $40,000 of cash from the issuance of common stock would not be booked as revenue, rather. It would be only recorded as receiving cash. Assets would go up by $40,000 and common stock would go up. Issuance of common stock is a financing activity. So we would say here that while the cash went up, net income was unaffected, right? So the way I would make the reconciliation would be to say net income unaffected, cash flow went up. So to reconcile the two, I'm going to add $40,000 here. Because cash was affected, up 40, income not affected. So take a couple of minutes and see if you can figure out how each of these transactions would affect the cash flow number versus the net income number, trying to compute the cash flow number by making adjustments to net income. And feel free to post any questions you have in the process. Okay, another couple of minutes. You want to check your work. If you've finished, you can go ahead and check it up here. And you can check my math. So again, the purpose of this exercise is just to kind of nail down an understanding of the differences between both cash and accrual accounting. The second item, performed services on account for $82,000, would of course have increased net income and had no effect on the cash because we didn't receive it yet, right? So we have to add to get to the cash number. Then you can see over here the payment of the dividend. I mentioned that dividends are not an expense. They're a distribution of earnings, would not appear on the income statement. And so we would have to subtract them because they do reduce cash flow, but they would not reduce the income statement, or income, I should say, on the income statement. Collected 76,000 of accounts receivable. Again, we would not record the income because it's previously been done when we recorded the receivable, but we would add that to our cash balance. Now, these were tricks. If there are no differences between the treatment of the cash and the net income, then there's no reconciling item. So when we pay 53,000 cash for other operating expenses, we are both expensing and reducing cash at the same time. And performing services for $19,000 in cash means that we get paid at the time we earn the revenue, no reconciling items there either. And then recognizing $3,500 of accrued utility expense at the end of the year would reduce the net income, but would have no effect on the cash flow. So this should add up to a cash flow of $76,000 for the period based on income of 44.5, subject to these adjustments. So if you got that, you got a really good feel for the accrual accounting system.
Eugene?
Yes.
There was a question about whether you can further explain how come 82K were subtracted from the cash flow.
Oh, the services on account?
The second one, I think, yes.
Yeah, the reason is that you perform the services on account, so you've earned the money. So the $82,000 would be recorded as revenue, which would increase the net income. However, you didn't receive the money, right? The services were performed on account. So to figure out what the cash flow would be, you have to take out that $82,000 that you recognize as income from the net income number. The way, again, to do the analysis is just stick with these two tables here, columns here, I'm sorry. That what was, I'm given a number of 44.5 here. And how was that computed? That would result in a difference between the net income number and the cash flow number. So if I know that the 44.5 included $82,000 of revenue that was earned but not yet received in cash, then to reconcile the two numbers, this would be a subtraction because you didn't increase cash by 82, but you did increase your income by 82. So you just want to look at what are the differences between the net. Key to this is you're starting with a net income number that reflects inflows and outflows, right, of revenues and expenses. and you're trying to figure out, okay, based on that number, what would my cash flow be? So anytime you have a difference between how net income treats the transaction and how cash flow treats the transaction, you have to have a reconciling number to correct those or to adjust those. Another example of that would be, take your bank balance, right? So let's say that your book balance in your cash account with the bank is $10,000, your checking account. And you wrote some checks that the bank doesn't know about yet, right? So the bank balance, to reconcile it, you would have to add those outstanding checks to your book balance because you subtracted those when you wrote the check, but the bank hasn't subtracted it yet from your balance. So this is just a reconciliation between the net income and the cash flows, accounting for differences in the treatment of these transactions.
Eugene,
Now yeah, go ahead.
sorry, just to follow up on that, I'm looking at the Google Doc that people are filling out, and I don't see a question on this, but I think a lot of people probably got the last couple wrong. So the performed services for 19,000 and the paid 53,000 for operating expenses. These two, I think people were kind of confused.
Oh, good. Okay. Yeah. So performed services for $19,000 in cash. So you earn the money, right? So you would recognize the revenue and you got paid. So there's no difference there. That would, another example, that would be if you had a book balance and you wrote a check and the bank, it cleared the bank, right? So the check, you subtracted it when you computed your book balance and the bank subtracted it because it cleared. So there's no reconciling item. You're only going to have a reconciling item when there's a difference in treatment. And this one recognized $3,500 of accrued utility expense. So remember, if you have an accrual, you're going to recognize it first on the income statement and then later on the cash flow statement. So here, the $3,500 is recognized as an expense. It's an expense that's incurred. So the $44,500 number reflects a reduction for that utility expense of $3,500, but you haven't paid it yet. So the cash flow is unaffected because you were going to record a liability there, right? You would expense the utilities. You showed utility expense, which would reduce your income, but there's no effect on the cash flow. So to reconcile the two, you add it back. It's good to look at that, Nicole. Thanks. That's helpful. Any other questions on that? So now we're going to really put ourselves to the test. And we're going to work the opposite way. So we're going to start out with a cash flow number right here, 39,000. And we're going to try to figure out what the net income was. So you're working this, the reason you go through this is to see if you really understand it. And in accounting, you can't memorize, you got to really understand it. So we're working from cash flow now to net income before we work from net income to cash flow. So this cash flow number reflects all the cash inflows and outflows. Where there's a difference between the recognition of revenue or expense on the income statement versus the cash inflow or outflow, we're going to have a reconciling item. Let's look at the first one together. So the company billed customers $62,000 for services performed, okay? Now, note the word there, the company billed customers for services performed. So would that be a net income number? Would you reflect, in other words, would that affect your net income? Would you reflect that despite the fact that you were not paid under the accrual method? Would you reflect that as revenue? And the answer is yes. You earned it, right? You performed the services. So the net income number would reflect $62,000 of revenue. Did you receive the money? No, the cash flow statement would not reflect the $62,000. So to reconcile the two, we're going to have to add back here $62,000, right? Because the net income did go up, but the cash flow is unaffected. So to reconcile the 39,000 with the 23, I know the 39,000 includes the net income or the revenue of 62,000, but the cash flow does not. So to reconcile them, I have to subtract. Again, working from cash flow to net income. So let's take a few minutes and try this one and see how you do. And I should tell you at the outset, this is a very demanding exercise. Again, it really requires an understanding of the accrual method. So I like to use this to just show you, to sort of exercise that way of thinking, because you're having to deal not with a transaction like we've talked about. Yes, if you have an expense, you expense it, and you're going to have a reduction of your net income as a result of the expense, and whether you pay the money and reduce your cash or increase your liability if you don't pay the money, that's easy, right? But then to actually get to the nub of the difference between accrual and cash, can you reconcile the cash flow with the net income? That's a harder exercise. It's application of those concepts. So take a few minutes and see if you can reconcile. Okay, another couple minutes and we'll review it. You can take a look if you're done with the answers I've posted. Again, you're working the opposite way now. So the question you're going to always ask is, what's the effect on income? What's the effect on cash? And what adjustment do I have to make to the cash flow number to figure out what my income is based on these adjustments? So you can see we collected $51,000 of accounts receivable. So cash went up, that's reflected in the cash flow. But remember, we would have recorded the revenue when we recorded the account receivable. That's when we earned the money. So that is not going to be reflected in the net income figure. So we have to subtract the 51,000, but it did increase our cash flow. That income is already in the net income figure from previously recognizing it. We don't want to recognize it twice. Well, we'd like to, but unfortunately the accountants won't let us do that, right? Incurred $39,000 of other operating expenses on account. So we've incurred $39,000 of expenses, but we haven't paid for them, right? And so we did reflect that expense on the net income number, but we didn't reflect it on the cash flow because it was a non-cash event. So we subtract the 39,000 to bring the income down by that amount because it reflects the 39,000 as a reduction, but the cash flow does not. Paid $31,000 of accounts payable. That did reduce our cash flow, right? That's reflected in there, the payment, but nope, it doesn't affect the income statement at all. So to reconcile, we add back the 31,000. Acquired $40,000 cash from the issuance of common stock. Well, we did reflect that 40,000, right, on the cash flow, but it is not an expense. So the $40,000 would not be reflected on the net income statement. So again, it did have an effect on the cash flow statement, an increase, but it's not income on the income statement. So we got to get it out of there. And then invested 21,000 cash in the purchase of land. Remember, land is not an expense. That would be an asset. So cash flow went down by 21, but income didn't. So we have to add it back to reconcile. Nicole, any from what you can tell from what everyone did, any particular one you want me to?
Yeah, so actually the second row maybe will be helpful because I think people were saying add 51,000.
Oh, the accounts receivable?
Mm-hmm.
Yeah, so so here we collected $51,000 of accounts receivable. Now remember, when we collect that money, the cash goes up. So we added $51,000 to our cash flow. That's how, that's part of what it went into the $39,000 number. But we did not record that as an expense. It had no effect on the income statement. So as a result, the cash flow did go up, collected $51,000 for the account receivable. So the cash flow went up, but the income statement didn't go up. So we have to subtract it. So again, what you want to look at is what went into the computation of the cash flow, right? We had revenues minus expenses. I'm sorry, we have cash inflow and outflow up here, right? Cash, pluses and minuses. And down here, we've got revenues and expenses. So in this particular case, by collecting money we've already recorded as revenue, there's no effect on the income statement, but we did increase the cash flow. So if we're going to figure out, okay, well, what was our income based on this transaction? We would say, well, there was no income. So we have to subtract the 51,000 because we've increased our cash flow by the 51 because we collected the funds. Any other ones you see, Nicole?
No, we're good.
Okay, anybody have any questions on that? Again, admittedly, this is a difficult exercise, but it's a great way of testing an understanding of accrual versus cash accounting. and can be done. You can go through this process if you have an accrual number or a cash number, and you're using the accrual method. You want to figure out what your cash or income is. You can make the adjustment. This shows you both ways to do it, but admittedly, it's a little bit tricky, no doubt. Reconciliations really are tricky. Okay, but I'm sure you probably do your bank reconciliation, and they're tricky. Let's move on now to financial statement analysis. This is particularly useful for lending decisions, but managers of businesses, owners can use it also. And I like to refer, when I think of this, I refer to, I don't know if you've seen this product, it's called Cardio Mobile. And there's a commercial that's making the rounds. It seems like every program I watch, they show it 4 or 5 times, but it's someone who walks up to people and says to them, "How's your heart?" And they'll say, "Oh, my heart's doing okay." He says, "How do you know?" So, "Well, I think it's okay." And he'll say, "Well, if you have driving your car, you have a check engine light. So how do you know your heart is okay?" It's a pretty cool device, actually. You can see here, it's hooked up to your iPhone by Bluetooth, and you put your fingers on this little device here, and it takes an EKG for you. And it can indicate if you have, I think, a tachycardia or some type of a heart malfunction potentially, and you know it right away. And it's cheap. It's like 89 bucks now, which is cheap. It's amazing what technology is doing to prices. Anyway, so how do you know how your business is doing? You can't get a Cardio Mobile because that's for your heart, but I can show you some techniques you can use and that banks will no doubt use when evaluating your business for a loan. So let's take a look. Now, I just want to mention, we're going to run through some computations, and in some cases we'll do them. In other cases, I think I'll just show you how to do them. And if you want to practice with it, you can. But the main point of this is to kind of understand what these financial statement ratios that we're going to look at, with the exception of the first one, which is not a ratio, what they tell you about your business and what a bank might look at. And just so you know, again, in the answer sheet, I'm going to give you all the computations right here and the descriptions that I mentioned in terms of what this says about the company. Okay, and then in the materials, which you'll have right here, will be definitions of the various ratios right here. Will be a full definition for each one that we go over. So you'll have the definition. We'll ask you, what do you think about this? What do you think it means for the company? And then our discussion will be fully reflected in the notes that you'll get at the end of the program. All right, so what do I mean by financial statement analysis? What exactly is that concept? So when we talk about financial statement analysis, we're talking about looking at the financial statements and trying to use analytical procedures, which basically are ratios, to see how our company is performing, basically what we're doing. So if you think about it, we use ratios for a reason. If I said to you, for example, that a company had $1 million of net income, would that be good? Like, do you think if I said a company makes $1 million this year, would that be a good income for the company? And you'll probably say to me, well, it depends. $1 million of income probably wouldn't be very good for a company like Apple, I would imagine. That's not even a rounding error to them. So a ratio will account for proportional differences by comparing two numbers, and the denominators will cause the numerator to be conformed so that you can make a comparison, even though dollar amounts might be vastly different. So when we're conducting these or using these analytical procedures, we're trying to assess the company's financial health, and investment professionals, lenders, managers, shareholders are all going to be looking at various aspects of the company. They'll look at profitability. They'll look at asset management. How is the company managing its assets? They'll look at financial risk. Now, when we talk about profitability, We're really talking there about the income that's generated by a business, but we want to know what that income is relative to the assets that the company is deploying to earn that income. Obviously, you want the higher the a high profitability level, so we can measure it on the basis of how much of a dollar of sales turns into, let's say, gross profit to the company. In other words, the difference between, if you're selling inventory, the difference between what you're paying for the inventory and what you're selling it at. We simply subtract the cost of goods sold there from the revenue, and that gives us the gross profit. We'd like that to be high, right? I'd like to have 100% on my inventory if I'm selling it. And I actually came up with an idea for that. You could probably get 100% cost of profitability, or I should say 100% gross margin, if you sold air, right? You have a store, people walk into it, they breathe the air. Every minute you charge them $20. There really isn't any cost of goods sold there, is there? That's the highest I figure you can get. If you think of any other ways that you think might be marketable, please feel free to contact me. I'm all in. Okay, so the higher the profitability of the company, the better. The higher the gross profit was really primarily what we use to measure that. And then you have other expenses that you're going to take off from that as well. When it comes to asset management, the fewer assets, or the less in assets that we deploy to earn a profit, the better. I don't want to hold inventory. That's actually why just-in-time inventory is so great, where you order the inventory just as you need it. If you have to hold inventory in storage, it could become obsolete. You got to pay storage costs, and it's money that's tied up in inventory that's not earning anything for you until the inventory is sold. And the same with your other assets, plant, property, and equipment. The less I use in assets, the more efficient my company's business is. So asset management really deals with how effectively the assets are being used by the business and by the management team. And then we talk about financial risk, which deals with the ability of the company to repay its borrowings in a timely manner. And of course, the lenders will be most interested in these ratios, and may be evaluated both in terms of the ability to repay the borrowings in a timely manner, okay? And we look at short-term and long-term considerations. Solvency is a big concern. And of course, that's more of longer term, the ability of the company to pay off its obligations on a longer term basis. So here is a new company. And what you might be required to do in a loan is to actually set forth projections. What do you think is going to happen next year? And banks are very interested in how accurate those projections might be in the past if you've done them. And we'll talk a little bit about that in the next module. We'll discuss budgeting. So we've got a new company here, and you can see we've got 2017 year-end actual. So it's in business for a year, and we're going to have a forecast. And let's just briefly look here. We've got the balance sheet. You might record the balance sheet again: assets, liabilities, and stockholders' equity. The assets must always equal the liabilities and stockholders' equity. The assets, what you own, including a lease, let's say, that you own. Even though you don't own the property itself, you have those rights. And on the opposite side, where those assets come from. Either borrowed to get them, you either had investors put into your company and you issued stock or gave them capital in your company if it's not a corporation, or you have retained earnings, earnings that you've made where revenues exceeded your expenses and your dividends, and you've kept them in the company, retained earnings. Call the assets, actual stuff you have, the liabilities and the equity sources of those assets. We also call them claims on the assets, because if a company were to liquidate, the liabilities would be paid off first and the equity would remain for the equity holders. We also said that we break the balance sheet down between the current assets and the longer term assets, fixed assets. Here you can see the goodwill. So this company had to have paid for that goodwill. Looks like they did have an impairment, or they're estimating an impairment that they're going to have. So something must have happened. Just briefly looking at this, you can see an increase in cash is expected, trading securities, inventory. Looks like it's going to be a decrease in inventory. I'm sorry, up here, increase in inventory. It's the accounts receivable decrease, 390 to 300. We might want to know why that is. Is it going to be collections, a higher rate of collections, or a reduction in sales. Let's see what they're planning for that as we go through. They also give you the investments available for sale at fair market value. Accountants do on the balance sheet, typically, we didn't used to do it, but I mentioned you normally go with historical cost, but your very liquid assets like investments are valued at fair market value. Liabilities. We again break those down between current and long-term, and then stockholders' equity. And do we balance? We do. Right here for both. Income statement. Sales going to go up a little bit. Cost of goods sold, up. Notice how you stop here. You have your gross margin or gross profit. That is a measure of your profitability. We'll look at a ratio on that. Then you subtract your other expenses. Tax rate's a little high. So this was a problem done before the tax reform. Earnings per share, if you're a corporation. Some information on operating cash flows, dividends, and market price per share. Some assumptions that they're making. These are just repetition, I think, of what we've just been through. Operating expenses. Okay. So if I were to say to you, well, look at this company, what do you think of it? I don't know. I mean, they made some money, right? They're showing net income, 200,000 up from 180. That sounds good. But I really don't know. I don't know how they're doing. I mean, this information is useful, but this is where the accountants are telling the story, right? And then the financial professionals and owners and lenders, they're the ones who use that information to answer whatever questions they have. So again, as when I mentioned that accounting is a communication business, we just communicate the information. We don't make an opinion on whether this is a good company or bad company, but we provide the information for professionals and other people, investors who may not be professionals, to then take it and try to answer the questions they have before deploying their resources in the capital markets by lending money to businesses or investing. So technically, what I'm going to go through with you while we do teach it in accounting classes, it's really finance. So if you have the finance module, don't tell them I went over this. No, I'm just kidding. It's normally taught in the accounting courses, but again, finance people also cover it. All right, so let's break down these ratios and take a look at how they affect this particular company and what we think about it. And while we're doing it, think how you feel what these ratios say about this company. Let's start out with liquidity ratios. So when it comes to liquidity, we mentioned liquidity simply means your ability to meet your bills as they come due. So we focus on the current liability side of the company's balance sheet and whether or not the company will have enough assets, current assets, and other funds to pay liabilities when they're due. Now you might wonder, well, why do we just compare the current assets and the current liabilities? Why don't we take all the assets, right? Because company could sell those assets potentially if they needed to pay off liabilities. Well, the reason is that, and you'll see with our first couple, we're going to look at working capital and we're going to look at what's called the current ratio. Well, that's fine. Yeah, that's true. And that's for longer term solvency. But the last thing you want to do as a company is have to sell off some of your equipment to pay a debt that's coming due now because you need that equipment in your company operations. So the liquidity ratios really are aimed at making sure that the company will be able to generate the liquid assets to pay its current debts as they come due without interrupting its operations by having to sell assets it really doesn't want to sell, but needs to maintain uninterrupted operations. So that's really the focus. So a company lacks sufficient liquidity and it may default on its current liabilities. Doesn't mean it's going to go out of business, but then it's forced to sell its fixed assets to pay those liabilities, resulting in interruptions of the company's operations. So the focus is to try to make sure that the company will have enough in its current assets and other funds to pay the liabilities when they are due. Now, this is not a ratio, okay? The first one, as I mentioned, current working capital is simply the current assets minus the current liabilities. So if we were to do this computation, and just in the interest of time, again, I've given you, what I would say is I've given you all of the computations based on the information that I provided. And a company can simply take this information, throw it into an Excel spreadsheet, and then write up the formulas, and boom, it'll automatically calculate everything for you. And so every year you can pop your statements into the Excel spreadsheet or have someone do it, and just push a button and all the formulas should automatically calculate those. But I've put these together this way simply to provide a means to show how the computations are done. So in the first one, we're looking at working capital. All we're doing is taking current assets and we're subtracting current liabilities. So if I went up here, you can see that I would just say, all right, well, my current assets, 715,000 for my projection. Right here, 765 for last year. And my current liabilities, 695 versus 700. So I'll pop these numbers in some cases, but again, the formula itself you have, and the computations in the answer key. What we want to really work on more is not so much the computation, which again is pretty easy to do, especially with computers nowadays, but it's more, what does it mean? What are we asking ourselves about this? So again, for 2018, we'll just say here 715,000, and we're going to subtract 695. Current assets minus current liabilities go 20,000 of working capital. 765. I'm going to subtract 700. Current liabilities, we get 65,000. All right, so this is in a vacuum, right? But when you look at projection, when you look at ratios, financial ratios, you're going to focus on two basic areas. You're going to focus on trends, good trend or bad trend. So I call that vertical, right? Within the company, how they do from year to year. And you're going to focus on industry standards. Where do you get those? Well, it depends on your business. They should have, it may be a professional organization that your business belongs to. You know, it would be slotted in, and you may belong to that organization and be able to get industry standards for your business or be able to research it. But they should be out there. What would be the industry standard for working capital? That's a good question, right? What should a company have in working capital? All this is the difference between current assets and current liabilities. Well, the answer is, well, it wouldn't be an industry standard for that, because that's a dollar amount and you have different sized businesses. So I don't know if 20,000 would be good for this business. It depends on the size of it, really. I mean, if it's a huge company, 20,000 working capital doesn't sound like a lot to me. But what I do notice here is a bad trend, right? I mean, they're really dropping in their working capital. I like to know why that is, going from 65,000 to 20,000. So in terms of a trend, they have much less liquidity, right? In terms of a trend. So I would be concerned about that. I'd want to know what's going on, and the other ratios will help us make that determination. Again, we really need to have more context as to what's going on here, but that would definitely catch my attention. And we're making, again, this is short term, right? Because we're just looking at the current assets and liabilities. So that's kind of how you do this in terms of these little cardiomobiles, I guess, for the financial statements. Let's move on to the ratios now. The current ratio, which is a classic ratio. And you'll notice now we're going to have industry standards to work with for this company so we can get some context. So you can see here the industry standard is 1.5 times. What does that mean? Well, we're taking the current assets, we're dividing by the current liabilities. So the theory is that you should have at least 1.5 times current assets compared to liabilities. Notice here, in terms of what this tells you, the current ratio, I would not use the word better per se it's not the best word here. I would say the current ratio from a liquidity standpoint is really safer the higher the ratio, right? And if I had $1,000 to every dollar of current liability, I think I'd be very, very liquid, right? However, you can be too liquid. Why? Well, you're not really earning much of a return on assets that are in a checking account, right? Or a money market fund or a T-bill account. So you want to make sure that your business, while you want it to be liquid, you don't want it to be too liquid. You want to have investments that will be earning money while the money's sitting idle, where you've got it, and put it to some risk, where you can afford to, as long as you can get your hands on the liquidity that you need to pay your current debts. But you can be too liquid. So again, rather than go through the specific calculations, which you'll have in the handout, let's just see where do they come up in terms of the current ratio, so we can do more of the analytical stuff, which is more fun anyway, right? So in 2018, the ratio is 1.03, pretty close to 1-to-1, 1.09. Now remember, this is a new company, right? So we have to take that into consideration in our analysis. All right, so trend-wise, they are going down, right? It's a slight decrease. So let me just adjust this a little bit so you can see everything. Whoop. Give me 1 second. I just managed to drop my pen. It's a problem with live television. Okay. So let me just reduce this a little bit here so we can see it together. Okay. So again, the industry average is 150, 1.5 times. So they're below that. And so we would say that from their standpoint, slight decrease. All right. And this is a little bit low for the industry average. And so if current debt is added, that would result in more of deterioration. So in terms of the current ratio, there are some concerns there based on trend, not as big a deal, but industry, a comparison to industry average. Now, this is a very intense ratio, the quick asset test ratio. And it's pretty much how quickly can you get your hands on money, on cash, if there were really an emergency. We take cash plus cash equivalents plus marketable securities plus receivables. And notice that receivables there says net. So I'll just mention in accrual accounting, what we will record as we've been doing it, we'll record all of our accounts receivable as we make the sales. But accrual also requires us to take into account what we expect not to collect. And every company is going to have some receivables that they are likely to turn into bad debts. And so they have to estimate what the bad debts are, and those bad debts are expensed in the year of sale, and they have to be subtracted as an allowance for doubtful accounts to give us our net. So that's partly under the matching concept of matching revenues and expenses. Obviously, if you have sales today, some of which you're not planning to get, you don't know who's not going to pay you, but maybe 1% you're not going to collect, then you have to actually expense that and reduce your receivables. And then when you know who's not going to pay, you write that off. All right. So anyway, that's what they mean by the net. So current liabilities. So the ratio is similar to the current ratio, but it's much more intense. You only put into the asset numerator the liquid components, of very liquid. So you'll notice what's missing here is really inventory, which is a current asset. How quickly can we put our hands on money? So how does it look? The industry average is 0.8. If you run the calculation, you'll see here that in 2018, the projection is 0.61. 2017, it was 0.7. So you do have a downward trend. Okay. What about the industry average? Well, they're really off of that, right? They're below the industry average. A little concerning. Again, they're a new company, so you have to keep that in mind. But there could be an indication there's a problem, potential problem with paying their current debts if they needed to. Now, you had COVID hit. So these could be very significant. A number of businesses had some difficult, especially restaurant businesses and all. May have to sell off assets they don't want to sell off. So this is a ratio. Tells you, boy, if you really have a problem, how quickly can you get your hands on money to maintain your liquidity, keep your operations going? And they don't have a lot of margin there, and they are below the average. Operating cash flow ratio. So you take a cash flow from your operations and divide that by your ending current liabilities. This is basically going to indicate how you're doing in terms of generating operating income to pay off your current liabilities as they occur. So that's very significant for companies in their prime. They want to be able to generate at least the cash, at least to pay off their debts as they come due. And they can maintain, again, some of these other assets, inventory and the like, but you really do like to see it in the operations of the company. If you run numbers, you'll see that for 2018, the estimate is a 0.40, 40% being generated that way, 0.38 last year, a little bit of an increase, again, below the industry standard. I think I might have mentioned this in our first module, but it bears some repeating, that what lenders will typically do and investors when they're looking at your cash flow statement. If it's a new company, remember again that we have a breakdown of cash flows. We have operating activities, revenues and expenses. We have investment activities, investing in machinery and equipment and buildings and the like. And we have financing activities. If you're a new company, brand new, you're probably not going to be generating a lot of your cash through operations because you're really not fully up and operating, right? You're mainly investing and you're financing. So this could even be in negative territory, your operations, and that's fine for a new company. And I think that's recognized. If you're in your prime, what they really should be seeing is your operations are cooking along, very positive. You may still be doing some investing, you may be doing some financing, but probably not to the same extent you were doing when you're new, unless, if you're growing, then very likely you might be continuing to invest and, grow. So all three, positive cash flow. And then a company that is basically towards the end of its life, you'll start to see the operations might still be somewhat positive, but now I'm sorry, what I should have noted here, by the plus, what I mean here is that you're investing cash. So actually what happens is if you're a new company and you're still investing, you might very well have negative cash flow, but your activities are higher. I don't want to confuse you. So in this case, you might show actually negative cash flow from because you're putting money in to investments, and your financing would be positive here. Then over here at the end, operating might still be somewhat positive because your operations, they are winding down. It could be negative. And your investing would be on the positive side, meaning by that, what I mean is that your cash flow would be positive because you would be selling your investments. So, and then on financing, you'd be paying off your investments. So that's what they'd be looking for in cash flow statements. The prime, this would be it here. So there, your operating activity should be in positive territory of cash flow wise. Investing, you could still be investing, that's fine. That might show negative. And if you're still doing some financing activities, that could be resulting in positive cash flow. So in this particular case, this really should be strong. They are showing a positive trend. And they are a little bit below industry average. Working capital turnover. So you can see here, this is going to be the sales that the company has divided by its average working capital. And so this is used to evaluate the money used to fund the company's operations and the sales derived from its operations. The expectation is, as the company matures, as I was mentioning, this kind of ratio would manifest by improving. So a higher working capital ratio is better. The higher projected net sales in future years will cause this ratio to increase. Meaning, and typically with a lot of these ratios where you're looking at activity ratios, you normally want your numerator high, denominator low. I'd like to have more sales using fewer or less in the way of assets. Working capital, the less working capital I need to fund my sales, keep my business going, the better. Why? Because working capital, again, you're not going to get a lot of return on that. It's money sitting around waiting to pay off bills. So if I can use less of that and invest my other assets in more productive assets like investment, higher paying investments, and maybe more equipment, other things to grow my company, that's better for me. Notice that a ratio that is too high could indicate working capital amount is too low. So you have to be careful about that. In this particular, to do the computation, you'll see that for 2018, they are at, let's see, for the 2018 number, for the working capital turnover, I've got them at 42.4 times. And I didn't do, for some of these, I didn't do the 2017. So we won't make a trend analysis, but the industry average is 48.5. So you can see they're a little bit behind what the industry average would be. And again, this reflects to some extent the efficiency of the use of assets. As I mentioned, when it comes to the evaluation of current assets and liquidity, again, being too liquid can be a problem. Liquid assets generally return very little. And so you don't want to overdo it. Let's talk about activity ratios. So these are used to assess how efficient a company is using its resources, just as we were just talking about. And so this is a very interesting set of ratios. The key here is to look at your operating cycle. And the operating cycle has to do with how long it takes you to collect your receivables, which is this first ratio, second ratio, which is the days sales in accounts receivable. Obviously, you'd like that to be very low, right? You'd like to collect your receivables in a day. Inventory, you'd like inventory turnover high, meaning you're not holding on to your inventory for very long. And then you also have your payables. You'd like to take as long as you can to pay your payables because normally they don't charge any interest on those. So when you take these three together, you calculate your cash conversion cycle. Okay, so in the interest of time, let me just quickly show you what the computations come out for this company. You can see how this puts together. So the days in inventory, which is calculated only for 2018, the projection, we'll calculate for this company at 103.11. What that means is that takes them 103 days to sell their inventory, to sell an item. Buy it, hold it 103 days, sell it. Industry standard 78 days. This is a really not a great result, because what it means is that, number one, the inventory is exposed to becoming obsolete. That's one potential. It could be damaged. Another potential, you're probably paying for storage. It's money tied up in inventory. So this would really be a bad sign for the company. And they're off by a good bit, it looks like. How long does it take them to collect on accounts receivable? Run this calculation. For this company, it's 69.96 days. Most companies, you'd think it'd be usually give you 30 days to pay. That's it. That could be an indication that their credit policies are too loose, which means their sales might be inflated, right? Bad debts might be an issue. So that would be a trigger potentially. Look what the average is though, 55 days. So comparatively to the average in the industry, it's not quite as bad as it looks, but it's still longer. So it is unfavorable when compared to the industry, and you know, it can be an issue. Now these two, again, the days in receivables and days inventory, are the longer the worse. You can make up for it though by deferring the payment of your debts. The days payables outstanding. How long can you keep, or does the company keep its payables outstanding? Well, in this particular case, you run the computation, 50.19 days. Industry average is 62. It's actually doing better. Lender might look at this again. You might be nice if you can defer the payment of payables, but it could be an indication to a lender that you're having difficulty paying your debts. So that can be a potential issue. But here they are meeting their debt payments, and they're doing it quicker than the industry average. Again, all the annotations I'd normally put in here if we had more time, I've given you in the answer keys. So what we do is we put together these three items. We put them together. So we have days in inventory, and we add to that the days sales and accounts receivable. We subtract the days of payables outstanding, and that's our cash conversion cycle, which measures for us how long it takes us to convert cash into use of cash for our inventory, or for a service company to generate the services, and then it turns back into cash. And so for this company, you run the computation, it's 122 days. What's the industry average? Well, 71. So this company is taking significantly below the industry average. There's certainly room for improvement, as we saw, because it is behind in the collection of receivables and for how long it takes to sell its inventory. So this is particularly applicable to a company, obviously, that's selling inventory as opposed to a service company, but the concept is there for service. How long does it take you to collect, be the main one for service. Okay, debt ratios, the last one, the last area we'll cover. I'm sorry, profitability also, but I'll just very quickly, I'll cover a couple of these and then you can see some of the other ones. I just want to make sure we have a little time to spend on profitability as well. So the debt ratios banks will be concerned about measures the extent to which the company employs financial leverage in its capital structure. Nothing wrong with that. Debt is cheaper than selling equity. Why? Number one, interest on your debt is taxable. They did cut back a little bit on the deductibility of interest for tax purposes in the legislation that they passed a couple of years ago, but that's only for really huge companies. So smaller companies, no. Also, debt is less risky because the debt holders are paid off first. So in looking at, there are a number of different ratios. Again, debt is cheaper, but if you start to issue too much debt and your company becomes over leveraged, then you have to pay a huge interest expense. The way they graph this basically is they'll say, okay, here's the cost to finance your operations, debt and equity, and the more debt you issue, lowers your cost, but then at some point it starts to tick back up when you have too much debt. So percentage of equity here, I guess, because you're issuing less and less equity, more and more debt to equity. And then all of a sudden it starts to tick up. You just kind of want to land right there. The more over leveraged you become, the less, the riskier your company is, the more you got to pay. So let's just look at the debt to equity ratio, total liabilities divided by the common stockholders' equity. And it indicates the degree of protection creditors have in case of insolvency, right? Because remember, they're going to get paid off first. The lower the ratio, the better. Again, it's cheaper, though, for you to issue debt because you can deduct that interest. This company, 91%, 1.04, industry average is 0.75. So the trend here is the reduction in the debt ratio, which creditors would like. Okay, and you can see for these others that same idea. This is something that's going to represent to the creditor safety, right? Total liabilities to total assets, the higher that ratio is going to be, the more concerned the lender will be. Okay, this is an interesting ratio, times earnings before interest and taxes divided by the interest expense times interest earned. Obviously, creditors would like to know that your earnings will more than pay for the interest on an annual basis. So the higher this is, the better as far as they're concerned. The industry average here means that your earnings before interest and taxes are taken out represents 24.5 times what your interest payments are. The higher that ratio is, the better. Let me just briefly to end up our profitability ratios. The higher, the better. We already covered to some extent this gross margin, right? Cost of goods sold. So you can calculate that in a ratio. The gross margin is sales minus cost of goods sold. Put it into a ratio, and you want the higher gross profit percentage, the better. I'd like it to be 100% for my company. That's what I would like. This is if you're selling inventory, right? So for 2018, this one is at 44.4%. The last year was 44.7. The industry average is 48. So the trend is pretty flat, and they are less profitable than the industry average. And let's see. Got the net profit margin ratio, which I'll let you look at. Return on equity is very good. What are the equity holders earning? And finally, the ROI. This is an important one, the ROA, return on assets, net income divided by your average total assets. So you obviously want your, again, net income to be high compared to the assets you use to produce that income. The fewer assets or less in the way of assets you have to use to produce your income, the better. Okay. Okay, so anyway, I've always provide more than I have time to cover, but I make sure you have notes. So everything is covered here, all of the answers to the ratio calculations and what each ratio means in terms of Terrapin's activities. And so again, hopefully this, and if, you know, again, you can put this into an Excel spreadsheet if you want at the same time for your own company. And this is a really good way to look at how your company is doing from that standpoint. I'll just finish up by just mentioning in our next class, we'll be talking about some managerial accounting concepts, different from financial accounting, with managerial techniques for using accounting information that you get in your company to manage it. And this is an area, you know, a lot of times my MBA students will say to me, well, Gene, I'm going to have my own accountant. But with managerial accounting, you really, knowledge of that kind of accounting information is extremely valuable because remember, if you're the manager or owner of a business, you're the decision maker and you don't want to delegate the decision-making authority to an accountant. Numbers also in accounting can be misleading. You could actually have a company, for example, that has a division that looks like it's losing money when in fact it might not be losing money from the standpoint of the business as a whole. Let me just give you a brief example of what your appetite for the next module. Make sure you come back. I remember reading in the Wall Street Journal a number of years ago that there was an article that said that General Motors is so bad off right now that every time they sell a car, they lose money. And I thought to myself, how can that be? You mean when GM sells a car, they lose money? Are you kidding me? So I called up the president of General Motors and they put me on hold for a couple minutes and he came on and I said, yeah, my name is Gene Cantor. I'm a professor at the University of Maryland. I just want you to know that let me ask you, how much do you make? He said he makes $40 million a year. I said, I understand every time you sell a car, you lose money. He said, yeah, we do. And I said, for 10 million, I'll save you a lot of money. And he said, okay, what's your advice? Is it worth 10 million? I said, absolutely. He said, all right, what's your advice? And I said, stop selling cars, okay? But I never got the check. That's good advice, right? Every time you sell a car, you're losing money. Stop selling cars. Well, the answer is, and again, this is a managerial accounting problem, and we'll get into this next module. GM has fixed and variable costs. Fixed costs would be its factory rent, or if it owns the factory, depreciation on the factory. It's got salaries, including the head of GM. And so those are fixed costs. You don't count those when you're trying to figure out incrementally when you sell a car. So even if GM is, yes, the total cost to sell the car they can't make, but the costs they already have to pay that are fixed costs, you don't count those when you're trying to figure out on a small interim basis whether or not you should keep selling cars. Yeah, if you can still manufacture them, forgetting those costs you're already locked into, the variable costs you can be concerned about are what they're called incremental costs. So anyway, the point of the story is the numbers sometimes can lie to you, and that's why a knowledge of managerial accounting can be very valuable. It's been a pleasure. I'll turn it over to Nicole, and thanks a lot for coming, and hopefully see you in a couple of weeks.
All right, thank you, Eugene, for this very insightful session on income and cash flow. I think it really helped for us to kind of practice by ourselves. All right, so everyone, please note that the recordings from today's lecture and our previous webinars are available for you to watch on our Maryland Rebooted website. I've just posted that in the chat room. So you can please visit this link to sign up for future webinars. And so I just want to briefly touch on our guests for our next lectures. And so we have a very exciting panel discussion planned with Mr. Andy Shalal. He's the owner and founder and CEO of Busboys and Poets. And so it'll be really exciting to have you there. It's in 2 weeks. And then after that, Eugene will continue with his third chapter on the accounting series. And then Dr. Mary Harms will get it along and start with the marketing series. All right, so again, the Maryland Rebooted program is here for you, offered by R.H. Smith School of Business by the University of Maryland, in an effort to really help Maryland state residents, particularly small and medium-sized business owners, to really navigate the economic effects of COVID-19. So we really hope that the webinar series can help you during this difficult time. And I think definitely this accounting series is really helpful. So again, thank you everyone for attending, and we'll see you in the next webinar.